What's up, guys? I'm back. This is week 5, and we're going to be going into debt. We'll just call this Debt 101. So, just like a lot of the other subjects that we've been studying, debt is a very in-depth subject of study. You could literally spend your entire adult career learning about this, and it's just something you have to keep learning, keep learning. So, today I want to give you guys an overview, show you a lot of the basics, how to find it, how to qualify for it. Mainly the stuff you're going to need to do your first deal and to learn more about debt. But just keep in mind, just like all these things, it runs deep. And this video is probably going to be a little bit long, so I'm just going to put it all in one video. We're going to do some cool stuff, though. We're going to look at different types of debt. We're going to look at term sheets. We're going to figure out how to calculate using a DSCR, debt service coverage ratio, so that you can determine primarily if your deal will even qualify, right? So that's super important, because what we're trying to do in this multifamily accelerator is we're trying to be able to eliminate deals, find out if they qualify, and then take it a little bit further and really go into more depth on underwriting and actual debt and all those things. So let's go ahead and get started. Today we're going to talk about benefits of debt. We're going to talk about different types of debt. We're going to talk about key things to remember. We're going to talk about some lending maxims. We're going to talk about NOI and the debt coverage ratio. I'm going to go through a term sheet, and then we're going to have a summary. So let's go ahead and get rocking here. Okay, so benefits of debt. So increased cash flow, first of all. So the cost of debt, 6 months ago was in the high 2s. Now it's in the mid 5s as of recording. So obviously it moves around a lot, but it's almost always going to be cheaper than your LP equity, right? So what do I mean by that? I mean, if you can go out and get a loan, let's say for 5%, and you can secure maybe 70 or 80% of your project under that 5% versus what you would have to pay your investors, which may be, a 6% pref and then plus whatever profits you make. So the moral of the story is they're a higher payout percentage. So that's why when people do their equity stack, or when they do their lending, they want to have as much of it as a loan as they can, assuming that the rate's good or better than what you would be paying your limited partners. So you want to structure it as high as you can, which is called a loan to cost. So the highest percentage you can get that secures it as debt, because debt is going to be your least expensive money that you're going to have. So you're going to want to have that be as high as you can. So, depending on what the lender will allow, and we'll talk more about that, it's called loan to cost. So the total cost of your project, what percentage of that are they going to allow you to borrow? Sometimes that's, we saw when the market got really, really kind of bad here recently, we saw that go down to around 50, 60%. And when the market was aggressive, it was up around 80, 85%, even higher for bridge loans and different types of debt. So generally speaking, though, you're going to be around 70 to 80% loan to cost. And then the rest of that is either going to be money you put in personally, or LPs in a syndication where you're going to have limited partners that come in. And again, that money costs more. So the more debt you use, the more you can increase your cash flow. And we're going to talk more about cash flow too. So it's the ultimate other people's money. So, I don't know if you guys were taught this, but I remember, I don't know where did I even learned it? Maybe in college. You always want to use OPT and OPM, other people's time and other people's money. And that is a secret to life, man. You need to take care of the people that are working for you, but you're using other people's time to maximize your profits. And then you use other people's money to be able to go further and have leverage. So that's the next thing we're going to talk about is leverage. So leverage is 3x or 4x. So what does that mean? Let's say you had $100,000 that you could use to buy a property. Well, if you could either go out and buy a $100,000 property, or you could go out and buy a $400,000 property and put 100,000 down and have the other 75% of that be debt. So then the returns are obviously 4x as well. So that's what leverage is. That's like actually I probably should spend more time on this, but that's the whole, probably the number one coolest thing about multifamily is that you can leverage money, and you can take that 100 grand and buy $400,000 worth of real estate. Now you can make that bigger. You could say you have $1 million, or let's say you raise 10 million with your LPs. Now you can go out and buy a $40 million building. So your returns on that are going to be 4 times as much as if you didn't use debt and you just took your $10 million and went and bought a $10 million building. So that's what leverage is, guys. I think most of you understand that, but it's actually such a bigger factor than people even realize. I mean, we realize that, it makes it so I can buy 4 times as much real estate. Most people can conceptualize that, but when you actually start figuring out the returns, leverage is probably the number one coolest aspect about multifamily and real estate investing in general, is that you can leverage your money. All right, tax advantages. So when you do a refinance, it is tax-free. So if you were to buy a property with bridge loans, which we'll talk about, and then you do a cash out refi once it's stabilized, all that money that comes out, whether it goes partially to the GP team, partially to the LP team, depending on how it's set up, is tax-free. So any loan proceeds are tax-free. And that is the secret of the rich, man. That's why, you hear people like Dave Ramsey, which please don't listen to Dave Ramsey, but you hear him saying, debt's bad, debt's bad. All the rich people, you look at like Grant Cardone, you look at all these guys that are really, really rich, even like life insurance companies, they're all using debt because, for example, let's say you were exiting on a business and you had a $100 million business and you're like, okay, I got my, my 10x multiplier of my EBITDA and I'm going to exit at 100 million. Well, a lot of people, when they first are doing businesses and flipping businesses, they'll do that. And then they'll be like, oh shit, now they have to pay taxes on all of it. When they could have just refinanced or took a loan out against the business, for 80 million, and then it would have been completely tax-free. They could have went and started a bunch of other businesses, put in different management, even step away from the company, still running it from a distance and get $80 million out tax-free versus getting 100 million and paying capital gains on half of it. So that's something that you really need to understand with debt is the tax advantages are tremendous. And you can continue to kick the can with refinances and things like that. It gets a little bit complicated, but just know that the tax advantages are really big here. Okay, so reduced risk. So obviously, when you're using leverage, you're only, you and your LPs are only putting in a quarter of the money versus 100%. So obviously, you got a quarter of the risk. Another thing about risk with lending is, and we're going to talk about this too. Actually, it's the next point. Lenders are an underwriting partner. So let's say that when we're starting out, guys, we're looking at $2 to $10 million deals, right? Even then, the lenders are going to have their own underwriting, and they're not going to lend on something that doesn't work. So the lender is like a fail-safe for you. Now, when you get up to $50 to $100 million deals, you're dealing with these large agencies, and they've got an underwriting team of 7 people that's going to be going through all the paper, all of the financials on the project, and they're going to be a tremendous partner to you because they have the resources to underwrite. Plus, they have the experience. That's all they do is they underwrite deals like 20 a week or whatever it is. So they have people that are analysts. That's all they do is underwrite. So you have to think, a lot of times people think of a lender as, I don't want to say an enemy, but it's like, the bank, But when you're in multifamily and you have these huge assets, you have to think of the lender as a partner because they're going to reduce your risk. They're going to double check all your numbers. Well, they're not even going to double check your numbers. They're going to do their own numbers. And then you can check your numbers based off of them. And they're not going to lend on it if it isn't a good project. So think of them as a partner. All right. Okay, let's go into types of debt. And I've got another slide I'll pull over here in just a second. So hard money. So I know a lot about hard money because I've used it. I've been a broker for it. I didn't tell you guys this, but I used to be a real estate broker, or I used to be a real estate broker, but I was also a mortgage broker prior to that. So I do have quite a bit of experience with loans and the paperwork and the qualifications. Most of it is in residential, but commercial is very much the same, although it is a lot. There are quite a few differences as well. But hard money. So here's the deal with hard money. Quick, super quick. It'll underwrite based on the project. They're not going to underwrite you at all. You can get it in like a day or two, but it's expensive. Anywhere from 8 to 12, even 14% sometimes for an interest rate. And then you've got, 1, 2, whatever points on the origination. And then you might even have exits. So Hard money is, really simply put, it's hard. You don't want to use it if you don't have to. But sometimes you can use it, and you can, if you know, let's put it this way. Make sure, if you're new to real estate of any type, you shouldn't be using hard money until you have some experience, because we often think, you see this all the time, whether it's in residential or commercial, people have these blue sky ideas of what the property's going to do. It's going to be so amazing. All these things are going to happen. And it just doesn't pan out the way it's supposed to. People that have some experience and they close a lot of deals, they realize, holy shit, where did the money go? I mean, we still made money, but we made like a quarter of what we thought. So with experience, you realize how hard it is to actually make money when you have all the different costs. You know, you got loan costs, and on hard money, you have your carrying costs, which are huge. I mean, the carrying costs on hard money, if you run it out for 6 months or a year, can eat your entire profit easily. And so you can get yourself in trouble with hard money. Don't use it unless you have experience. That being said, there are times when you can grab some hard money and you can flip a deal, or you can even use transactional funds, which I didn't put on here. If you already have an in buyer lined up, you can just come in and say, hey, I'll pay you, 2% to have your money for a couple days because I already have an in buyer. There's transactional, and then there's hard money where you're going to keep it out for a few months. There are circumstances where it makes sense. We're working on a land development deal right now in Denver, where the guy that brought the deal purchased the land with hard money because he got like 20% off to do that. So there are times when you want to use it. Just be careful. I mean, it'll eat your lunch. People don't realize, when they don't do a proper pro forma, they don't realize how quickly hard money will take all of your profits. It's insane. Even agency debt. So we'll go on to agency debt. This is your Fannie Mae, Freddie Mac. And I've got another sheet I want to pull in. I'm gonna go through these other ones, and we're gonna pull in a sheet that goes into detail on agency, bridge, and also HUD debt. So keep in mind, guys, there's fixed rates, there's floating rates that are based on a basis, depending on what basis they use. There's interest only, and then sometimes it'll be interest only for a certain period. Generally, it is. Sometimes certain loans won't even allow interest only. So interest only is just simply the loan amount times the interest rate divided by 12. Super easy to figure out. And then there's principal and interest where there's an amortization, which means you're paying down the actual loan as you go. So let's say that you have 5% interest. It could be interest only for 5 years, and then it amortizes at 30 years, meaning over a 30-year term, to where at the end of that 30, or maybe it's a 25-year term because you already used 5 of it. So you got 25 years, it'll amortize over. And then by the end of that 25-year period, your loan will be paid off. So there's principal and interest, and then there's interest only. Now, when we're qualifying loans, as we get a little further along, we're always going to use principal and interest just to qualify. It's a safe way to do it. Sometimes when you're using interest only, some of the lenders maybe on bridge loans might allow you to qualify on interest only, but just for safety of what we're doing, I don't want to get too intricate, too into the weeds. We're always going to qualify based on principal and interest, which is a higher payment, which makes it harder to qualify, but keeps you safe. All right. Mezzanine debt is something that's used more in construction. So mezzanine debt is where, it can be used in multifamily too, but it's basically where, for example, I have a buddy that builds, he builds hotels. He built the car dealership, the auto mall in Scottsdale. And so he would get a construction loan on that for, I think 80%. And then he would go out and get a mezzanine debt on the second part. It's kind of like equity, but it's debt. So, it's not used that much in multifamily, but I want to throw it in here. And then there's recourse versus non-recourse. So this is huge. Recourse means they can come after your personal assets. Non-recourse means they can't, unless you do what's called a bad boy carve out, which is where you basically break the law, or you cook the books, or you do something, or you're taking money out of it, or you're commingling funds. Ooh, I don't know if I said that right, but the point is they can make it recourse if you do things that you're not supposed to be doing. But generally speaking, it's non-recourse. And most multifamily loans are non-recourse unless you start going to banks. If you start going to local banks and credit unions, you're going to run into recourse. Okay, so I have another sheet on this. So we'll go through in a little more detail here. All right, guys. So this is just based off my research. Keep in mind that, obviously I'm not a multifamily lender. I do look at loans quite a bit. I do have a lot of experience being a mortgage broker in the past. I'm not currently one. And also, this is a general guide. I guarantee you'll find something on here that's probably wrong or not exactly right. And then with lending too, keep in mind there's so many people providing it that there are different, there are people that are going to change things around. This is just going to be a general guideline. So the lending maxims, I've actually got these in some later slides, but we'll go over them right now. The bigger the loan, the more options you will have for debt. So that's counterintuitive for a lot of people when they come into multifamily, because they think, oh my gosh, it's a big, huge multifamily building and it's going to be so hard to get a loan for $80 million. But the truth of the matter is, the bigger the building, the less the risk. And, that's given that you have an experienced operator, someone with the net worth to cover that loan, like the team is in place, right? The banks it's easier to get loans. As a matter of fact, it's actually one of the easiest parts of doing multifamily is getting the loan if you have a big enough deal. Now, if you have like a $2 million, $3 million deal and it's like student finance or student housing and then you're going to have trouble finding debt. I actually had a deal that I was a partner with Grant Cardone on, which was freaking awesome. I wanted to close it, but it was a $3 million deal in Arkansas. And when we went to go get debt for it, the agency debts wouldn't touch it because it was 50-50 student mix, which they don't like that. It either needs to be all student, or I think it has to be above 70%, or not student, right? So we ended up having a heck of a time to get a loan for it, and then they wanted recourse. And anyway, the deal fell apart for several reasons, but that was one of them. So lenders are partners. We talked about that. They can serve as a secondary or even a primary source of underwriting and risk management. If you have a good deal, I skipped one there. Good deals bring good debt. Bad deals bring bad debt. So just simple way to think about it. Bad deals might even not bring debt at all. They might not even be able to get debt. The last one is, if you have a good deal, good debt will be easy to find. And that's the thing, man. If you got a lender that's backing you up on a deal and they're like ready to lend you the money, then you got a good deal. And as long as you got your team together, obviously you'd have to have your team together for them to be ready to back you, but that means you've got a pretty good deal. Okay, so we're going to talk about two types of bridge loans, non-recourse and recourse. We're going to go through this relatively quickly. I'll give you guys a copy of this also so you can have it. I also put it in the WhatsApp group. So bridge loans, initial terms are usually 2 to 3 years, maybe even 1, maybe they go to 5. This is just kind of a generalization. And the extensions are subject to debt service coverage ratio hurdles. So what that means is, like, if you get to the end of the 3rd year and you're like, oh shit, we can't refi yet, we need more money, or we need more time, then they'll say, okay, as long as your DSCR is above 1.25 or 1.35 or 1.15, whatever they say in their underwriting guidelines, then we'll extend you out a year, and they usually are going to charge you for that as well. And we'll go into how to calculate. Sometimes it's called DCR, debt coverage ratio. I just like saying DCR, but it's actually technically debt service coverage ratio. But I just say DCR because it's a mouthful. So on bridge, so let me go back and explain bridge loans. So bridge loans are basically when you're coming into an asset that's not stabilized, and it's going to take a couple years to get it up to market rents and get it stabilized, and then you're going to refinance it with agency debt. That's usually the plan, right? So, this place needs CapEx, it needs the rent stabilized, we need a better management team to get the vacancies down, and then give us 2 years to do that. Here's our plan, Mr. Bridge Lender. And then after 2 years, or 3 years, whatever it is, our exit plan is to either sell or refi, most likely refi into an agency debt, and come take out that existing debt. So that's what bridge means. It's like a bridge to get to the other side, right? So they're higher interest rates, and oftentimes they require a rate cap. So one of the things that's really been hitting our investors recently, or us, I guess, as the investors, has been having to buy these rate caps, which can be, I wish I knew this percentage. It's slipping my mind, but they get very expensive on large deals. They can be $300,000-$400,000. And what that rate cap is it's basically insurance that says if the index moves up, so you've got your index plus you've got your margin, which makes your interest rate, right? And the index is vary. They're usually based on SOFR, but if the two of those together gives you your rate, and if SOFR moves up and you get to a certain, let's say you buy a rate cap at 6%. Well, if it happens to go higher than that, you're ensuring that it doesn't go higher than that. And the lenders will require that because they realize that if you go above 6%, I'm just giving you examples for numbers, that you won't be solvent. Like your DCR will be out of whack and you won't have any cash flow and the project could fail. So they're going to require you to cap that rate, which is basically an insurance policy you're placing on the front end of the loan. It gets expensive. Okay, harder to find for small loans. Everything's hard to find. I shouldn't say, it's just harder to do smaller loans in general. There's more options at 5 to 10 million, and there's a lot more options at 10 million plus. We're talking about non-recourse bridge loans, okay? Interest rates are driven by the loan amount, the higher the better. The borrower's experience to the market and rehab plan are specific to the market. So we want this borrower to be in the market. We want him to be, Mr. Smith has done, not only is he already in Phoenix where this property is, but he's got this property's in Phoenix. He's got projects in Phoenix. And not only does he have projects in Phoenix, but the projects in Phoenix had a similar rehab plan to the one he's doing now. So we're like, okay, he knows the area. He's done this before. That's what they're really looking for. They're also going to look at the exit strategy. Is it a refi? Is it a sell? They're obviously going to look at cash flow because that's determined by the debt coverage ratio, which I'll show you in a minute, and the stabilized value. So once you get everything done in your plan, how's it going to be? What's it going to be at? Leverage and debt coverage ratio. Okay. So moving on, lenders change constantly. Like appetites move with market conditions. Like when this market shifted like crazy in mid 2022, like the third quarter of 2022, I mean, we couldn't even like we would try to get a debt quote and then it would change like within 2 weeks. So it was moving really fast. So these guys are protecting their investors and protecting themselves, and they will quickly change terms. And we had a lot of deals that fell out because the term sheet that we got and underwrote the deal on based on a certain rate moved so much in such a short period of time that we had to go back and we had to renegotiate the terms with the seller, and the brokers don't like that. And it was a tough time. Things are stabilizing a little bit more now. But these guys will change. Like they'll change their, obviously the rates move, their terms move, they'll cut down the loan to cost, meaning that they won't let you leverage as much. All that stuff subject to change based on the market. Like we talked about, it's used for properties that are less stabilized, and or under market rents. You can close quicker with a bridge loan. The closing costs are going to be higher. It kind of depends on the loan amount, but you can get some examples there. Origination fee, typically 1% to 2%. Exit fees can be a minimum of 18 months interest. They will do a little bit higher loan to closing or loan to cost. Lower prepayment, because obviously your plan is to exit. Like for example, the prepayment could be that you have to have 18 months of interest. So what does that mean? That means if you haven't been in the loan for 18 months and paid us 18 months of interest and you want to exit, you have to pay whatever is left of that. Borrower needs experience. We talked about that. Tax returns not required, but credit will be run to check for bankruptcies, litigation, etc. Post-close liquidity of 10% of the loan amount. So when you close and you've got a $10 million loan, you got to have $1 million in the bank. Pretty simple. So bridge loans they're interesting. So this is a bridge loan that is a bank bridge loan. And these are a little bit less common, I think, or at least they have been in my world, but they actually have recourse. So they want a local sponsor. A lot of these things are going to be the same. Some are different. They want a local sponsor with strong secondary income, short-term loan, 1 to 5 years. You can lock the interest rate at the loan application, which you can't do on other types of loans generally. It's usually under 5 million because you're dealing with a local bank. Interest rates are driven by 50% of it is based on the leverage and the debt service. So how much is your loan to cost? Are you borrowing at 50%? Or are you borrowing at 70%? And then the other part, and of course the debt service, which we'll talk about, that's the DCR. And then the other part is 50% based on the borrower's experience and the borrower's balance sheet. So just like any bank, this is more like, think of this more like a residential loan almost. although it's not, but it's the same in terms of they're going to look at your credit score. They're going to look at your income. Whereas on the other ones, they don't look at that. Okay, shorter amortization, which means that it's a 20 to 25 year arm or amortization. So that's just going to make your payment higher than it would be if it was a 30 year. Most bank bridge loans are full recourse, require a personal guarantee. Everything is negotiable with the bank. You can go in and try to change everything you want. Lenders change consistently. We talked about that already. That's the same for both. Used for properties that are less stabilized. That's the same for both. Quicker closes as fast as 30 days with the bank. Often lower costs with the bank. Higher interest rates, higher loan to cost, and net worth greater than the loan amount needed, and post-close liquidity. So the key principal or the person that's signing on the loan, also sometimes called a sponsor, needs to have a net worth that is greater than the loan amount. So if it's a $10 million loan, he has to have $10 million net worth. And then post-close liquidity, in this case, on the other one, it was 10%, but it may need to be 25%. So if it's a $10 million loan, you may need to have $2.5 million in cash in the bank. Okay, now let's talk about agency debt, which is probably one of the most common used. It does work for smaller deals, but again, it's always better to have bigger deals. You really shouldn't be, unless you have a sweetheart deal, I wouldn't even mess with deals that are under like 50, 60 units, quite honestly. It's just harder to make money. There's more things that can go wrong. We've talked about that. Typically it's a 5, 7, 10 or 20 year fixed with a 30-year amortization. Fixed term has some flexibility, like you can move that around. Interest only is available on these generally. Lighter soft costs and faster processing, generally 45 to 60 days. And when we say lighter soft costs, actually it's lighter than both bridge and HUD. Programs vary based on the area. So they have these program buckets for like student housing, small balance, standard balance, and there's a lot more, I'm sure. Top markets will fluctuate on LTC. So, for example, I'm just randomly saying this, but maybe in Chicago, they'll loan up to 65 because they don't like the market right now. And then in LA, they'll loan up to 75 LTC. Of course, I don't know those numbers exactly, but I'm giving you examples. Prepayment can include yield maintenance and defeasance, and that's a pretty complex thing. We're not going to go into it, but just be aware of the prepayment and the exit plan that you have. Generally requires a net worth equal to the loan amount and liquidity equal to 9 months of debt service. So that's something that we're seeing a lot, right? Is that you need a sponsor or a key principal that has a net worth of the loan amount. That's pretty common. You need that for pretty much all of these. And then in this case, they're saying 9 months of debt service. So what that means is just times the payment times 9, and that's the liquidity. Obviously, a lot less than it. You need less liquidity on an agency debt than you do bridge. Okay, so now we're going to go into the HUD debt. I've never done one of these, but they're pretty interesting. So there's some cool things about it. So this is called a 223F. And people tend to think that, oh my gosh, HUD takes forever. It's a big process. And I think it's over exaggerated, but it does take longer, but I don't think it's as hard as people think from what I've studied on it. So they're generally lower interest rates, 50 to 60 basis points. So that means if it's a 5.5 with an agency, it could be 5% with HUD. So it's less. And that's even with mortgage insurance factored in, because mortgage insurance is required on HUD loans. I'm sure there's some stipulations there, which I'm not familiar with exactly. So 35-year fixed rate. So that gives you a smaller payment, right? Fully amortizing. They don't allow interest only, but they extend that. It's a 35-year fixed rate. And guys, like in 2021, these HUD debt loans were like 2.5%, and they would be fixed for 30 years. So now I don't know what they are right now. I'm assuming they're probably in the high 4s, low 5s, but they're generally going to be lower than agency. So there's no borrower minimum net worth or liquidity. So they're not going to come in and say, you have to have the amount of the loan like the other ones have, but they do require what they call a gut check, meaning you can't be like zero funds, no experience, and bad credit. Like you don't have to have exactly the perfect amount, but you do need to be somewhat reasonable on paper, right? They take longer. They take about 90 to 120 days. So if you're in a situation where, depending on what your seller's trying to do, you may need to, you just have to account for that when you're doing your contract if you plan on doing a HUD loan. Higher leverage, longer term, more flexible. Tertiary markets and smaller markets, they work well in. One primary program with many options. So it's not like a bunch of buckets, it's just one program. Prepay is generally 10 years and declines annually. So if you pay it off in the first year, you pay 10%. In the second year, you pay 9, 8, 7, etc. Can be changed or reduced because it is negotiable, but that will increase your rate. So if you're like, oh, I need it to be able to pay it off in 5 years, they'll be like, all right, well, we're going to raise your rate by 1%. So you have to calculate that out and see if that makes sense. HUD does not have to be affordable housing. That's one misnomer. People think that it's always got to be like Section 8 rent restrictions. It does not. The process is not as bad as most people think. It's a one-stage process. HUD does not fund 500K plus units. I'm sure there's exceptions, but in general, they do not like high-cost areas. So like New York City, maybe even Miami. If you've got something that's over 500K per unit, HUD's not going to be the right one for you. Great for primary assets in a trust. Set it up and put it to bed. So let's say you have this, your family owns like this big, beautiful building downtown. They might put HUD debt on it, lock it up at 2.5%, and just forget about it for 35 years. I mean, that's kind of what this is used for. Okay, similarities between HUD and Fannie. Both are non-recourse. Both are assumable nationwide and provide cash out. Both are a minimum of 5 units. Both can finance apartments of various types. Both are generally longer term than bank or credit union. Both are general commercial loans and will require appraisal, property condition report, etc. Both can fund capital improvements / identified improvements. All right, guys. So that's our deep dive on the debt, agency, bridge, and HUD. So let's go back to our slides. Woohoo. All right. So we're cruising along. We're about 30 minutes in. Okay. Key things to remember with debt. Just like with any real estate projects, you want to start with the exit in mind. So people, this keeps coming up, and it's, people always make things rosier than they are when they're new. That's just, I don't know, because they're so excited. They're so enthusiastic to own something. And they're like, oh yeah, we can get this much for rents. Everything will go perfect. And in 5 years, we'll make $2 million. Like, you've got to really be careful with that blue sky, rosy cheek, whatever. I don't even know what to call it. But I see it with people. I've talked about this a lot in the course, but it's important. I've seen it with people, in housing, and they bring me deals, and I'm like, that's not a good deal, and they'll chase it forever, and then they'll lose money. So start with the exit in mind, and don't be afraid to walk away from a deal. And that's another thing about a lender. They're going to help you walk away from a deal because they're going to look at it and they're going to say, So use accurate forecasts, meaning don't get too aggressive on the future rents. Like, I've seen that 1,000 times. Like, you need to go out and you need to go to every single apartment that isn't comparable. You need to shop it. You need to know the vacancy. You need to walk the units. You need to think of it like you and your wife are going to go and look at the property, or you and your husband or whatever. And you need to actually say, why would I pick this apartment over mine? And what is the rent here? You need to really know your competitors. People just kind of say, oh, well, it looks like in this area, the rents are going to go to here. So we'll just forecast to that. And if we forecast to that, we can refi in 3 years, blah, 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 blah. And it just doesn't happen. And then they get themselves in a bad situation. And it's happening to a lot of people right now because the market rate has changed, and their 3-year locks are coming up, or their 2-year locks are coming up, and their debt's has matured, and they have to make a higher payment. So now they're in bad situations, and you're going to see there's a lot of investors losing money right now. Make sure you have cash flow. So the debt coverage ratio will make sure that you have cash flow, because you can't, and we'll go into that. You'll see how that works, because you won't be able to get a loan unless usually you have 1.25 DSCR, which means 25% of that's cash flow. Read the fine print. Some of these lenders, I mean, there's so many different lenders out there, and they're, the agency's kind of pretty staple or boilerplate. But when you start getting into some of these bridge lenders, man, they can do some really weird stuff. Like, they can come in and change things on you. But they can only do what's written in the contract. So make sure you read the fine print. You have your lawyer review it. Make sure that you understand the loan product. Everything comes from net operating income. Again, I told you that's the most important term in multifamily, and all of your loan underwriting is based on that. And good versus bad debt. I just want to throw this in there to show that Dave Ramsey's kind of a fool. Him and Susie Orman. There is good debt. Bad debt would just be unsecured debt that's not making you money. Anytime you can take debt and use it to make money and you're doing it responsibly, that could be good debt. Bad debt is where you have debt against something that's not bringing you income in, or it's bringing you less income than the debt costs. That'd be bad debt. So pretty basic. These lending maxims we already went over. So let's just read through them again. The bigger the loan, the more options you will have for debt. Lenders are partners that can serve as a secondary or primary source for underwriting and risk management. Good deals bring good debt. Bad deals bring bad debt or no debt. If you have a good deal, good debt will be easy to find. See, there was something else I wanted to talk about. I forgot. Okay, so debt service coverage ratio is net operating income divided by total debt service. So let's do a couple of examples here. So DCR, if it's below 1, that means that you can't, it won't cash flow. So actually, let's just do it with some examples. That'll be easier. All right, so let's say that we have a property with 100,000 NOI. And we want to get, let's see, how are we going to do this? So if it's got, actually, let's back up a little bit. Let's say we have 50 units that make $1,500 per month. And we're going to annualize that. So we're just going kind of back to our quick napkin underwriting. So we'll annualize that times 12. Then we'll times it by 0.95 because we have 5% vacancy. And then we don't have any other income, but we'll times it by 0.55 because we have a 45% expense ratio. Hopefully you guys remember this this is just really simple napkin underwriting. So now we've got, let me do that math real quick. Pull up the calculator. So we're going to say 50 times 1,500 per month per unit, right? Times annualized times 12. That gives us 900,000. And then we're going to times that by 0.95 because we have 5% vacancy. It's probably higher than that, but just for sake of example. And then we're going to times this number, which is our gross income, times 0.55 because we have a 45% expense ratio. So we get to keep 0.55 of it. So in this scenario, we have a net operating income of $470,250. Now, let's say we were going to buy this building at a 5 cap. Let's say it's a 6 cap. So I'm going to divide this by 0.06, and that gives me a purchase price of $7.8 million. So we got a purchase price of $7.8 million. And let's say that we're going to put 30% down, okay? So if we put 30% down, wish that calculator would stay on top right there. So let's go clear and let's go 7, 8. If we're going to put 30% down, which is basically going to be our LPs and whatever money we put in, then that means we're going to be financing 70%, right? So we're going to times our purchase price. And this is, guys, I'm not putting capital expenditures in here. There is a little bit more that goes in here. But just for quick math, underwriting, for napkin underwriting, basically, times 0.7 will give us our loan amount. So let's call it a loan of 5.5 million. Now, if we were to figure interest only on that, we could do that really fast. We could say, we could just times this by, now remember, when we do our debt service coverage ratio, we're not going to use interest only, but I just want to show you, for example, because I don't have a mortgage calculator, I'll get it off my, actually I can pull one up, never mind. I'm going to show you how to do interest only real quick. So let's say this is our loan amount, and let's say we're getting at 6% interest only. So we're going to times it by 0.06. And then that's going to give you your annual debt service. So in this case, our annual debt service is probably a better way to do this. $327,600. So now we have our NOI and we have our annual debt service, and we can see that this deal is going to work, because remember that to figure out the debt service coverage ratio, it equals NOI divided by debt service. And this is all annual, right? So now we know what that is. We've got our NOI is, let's just call it 470,000. And then we're going to divide that by 327. And that's going to give us our debt service coverage ratio. Boom. So 1.43. So that's what you want to see, guys. Now we're going to go back and do this not as interest only, because it's going to make it a little bit tighter. But you want to have a deal that has to be at your DCR. Well, I guess I should just put that in our debt service coverage ratio. Should be greater than 1.25. So what that means is that when it's all said and done, this is how much cash flow you have. So if you've got 470,000 in net operating income, then remember, net operating income didn't include our debt service. Remember, we talked about that last time. So now we know what our debt service is. Minus 327 equals, that means you have 143K per year in cash flow. That's pretty good. So you could divide that by 12. That's almost 12,000 a month in cash flow. So that's what you're looking at with a little 50 unit, or I shouldn't say little. I mean, that's pretty good. So that's after you pay everything. You got 12,000 a month. Well, now you got to pay your LPs out of that too. So that's part of your cash flow, but that gives you an idea. So now let's go back and figure out the debt service for 5.5. I'm just going to do this on my phone because I have a program on there. You guys can pull up any type of amortization calculator, but I'm going to do it on my phone real quick. Hopefully real quick is probably not accurate, but okay. So I wonder if you guys can see this. So I've just got this little program here, and it's called Loan Calculator. And so I'm just going to type in the loan amount. There is a factor you can use. Like you can times, I don't remember it. I think it's times like 1.3 or something, but it's not accurate. So I just use a amortization. There is like a factor if you want to figure this out real quick instead of, I'm not going to go into it because I don't use it, but I know Grant uses like a factor, 327, but it isn't accurate. Honestly, it's just a way to do quick math. But since we have the actual loan amount here, so we have a $5.5 million loan, and it's going to be amortized over 30 years, and it's going to be a 6% interest rate over 30 years, calculate. So the monthly payment is, let's go down here. So we got 5.5 million at 6%. Principal and interest. The difference is we're paying principal down now. Equals, it's really close. It's 32,975. So I'm just going to say 33,000. And then I'm going to say times 12 equals 396. So the difference between interest only and not interest only is 396 minus 327 equals 69,000 a year that you're going to be paying in towards principal, right? Now let's see if it works. Running out of room here. If we take our net operating income, 470, divided by our true debt service, which is principal and interest, of 396, we get 1.18. So we're a little bit tight. So technically this deal doesn't qualify. Now, are there lenders that would accept a 1.18? Absolutely. They're going to look at different factors. Just a general rule is either 1.2 or 1.25 to be conservative. So we're a little bit short. We're at 1.18 on this debt coverage ratio. Now, what do we have to do to get this at the right price? Well, maybe we have to offer them, let's say we offer them 7 million instead of 7.8. So we have 7 million times 0.7, which is going to be a $5 million loan, right? So now we've got what I'm doing here, guys, is I'm figuring out what do I have to buy this at in order for my debt coverage ratio to be 1.25. So let's see if we buy it at 7 million and we take a loan for 5 million. So now we've got, hopefully you guys are following me on all this, 5 million. And I'm going to figure out the payment for 5 million. And we're going to use principal and interest this time. Calculate. Let's see here. It's a little bit less. So now we're at 30,000. So we're going to say this is 5 million at 6% principal and interest equals 30K. 30,000 times 12 months equals 360K, right? Okay, so now let's try it again. So we went from 396 to 360. So we dropped down 36,000 by reducing the purchase price by 800,000. So now we're at 7 million. So now let's see if it works. So we're going to say our net operating income. So remember, right here's our formula. NOI divided by debt service. So we know our NOI is 470,000. So I'm going to say 470 divided by our new debt service, annual debt service is 360 equals, boom, we got it. So now we can even fine tune that more. We've got a 1.3. So now we can even fine tune that more, and maybe we can offer them 7 point, because they're probably, if the assets listed at 7.8, they won't take 7. Maybe it's a competitive market. So you can go back and figure that out to get your number exactly right and get it right at 125 or a little bit higher. This is actually where you'd probably want to stay. But if it was super competitive, you could figure it out. Maybe you can offer them 7.3, 7.35, something like that. Okay, so that should give you guys an example for debt service coverage ratio and how to use it. Okay, now we're going to take a look at a term sheet and then we'll be done. So let me pull in. This is a term sheet that we have recently for building. And we're just going to go through this. So basically what happens is, oh, I know what I was going to tell you earlier. I just remembered. What happens is you're going to want to, when you're looking for debt, you're going to want to make some friends with some lenders. Don't waste their time, but make sure that you're serious about the deal. You know, you should never be engaging a lender until you've already done all the stuff I've taught you so far. You should have your team put together. You should have your napkin underwriting. You should probably even have your full phase 2 underwriting done just so you can see if it can work. And then you should know that it's got that based on these rents that are accurate and you're forecasting correctly, that it's got the debt service coverage ratio works, that the NOI is correct, that the expenses are correct. You should have all that stuff done before you engage a lender, because you want to not waste their time. You should have a team. You should be able to put everything together. Now, that being said, it's okay to engage them a little bit and maybe learn, but just keep in mind, you want to be respectful of these people's time. So what happens is a lot of times on bigger deals, they're going to have a in-house lender, like CBRE will have an in-house lender. And it's good practice, in my opinion, to use their in-house lender plus one other lender. So one of the things that they like, the broker's going to like, is if he knows that you've talked to his in-house lender, then that means that he's like, okay, well, hey, you know, Sean, did you talk to Brad? Did you give him over the numbers? So then I'm showing my offers based on his in-house lender, because he trusts his in-house lender. He knows that the guy has experience. He knows that he's going to give us a good debt quote, which this is what we're looking at, is a debt quote. So it's always a good practice to use their in-house lender because it makes the broker feel comfortable. It builds relationships, but it's also a good practice to use your own lender as well in addition, and see what they can do. Now, keep in mind, most of these lenders are going to be brokers. That means they can go to all these different places and shop the debt. They've got all these different options. Sometimes when you're working with a specific, I mean, almost always, I'm always working with debt brokers. So they're actually looking all around, and based on your loan, they're trying to find the best deal for you. So again, they're on your side. So let's just take a quick look over this. So this was recent, March. You know what? That date automatically updates. That's funny, because I know I didn't get this. This March 5th is today, but it automatically updates. That's kind of a cheesy thing to do. All right. So maximum loan amount shows you here based on a 5-year fixed full term interest only. So what that means is this is going to be, it's going to be due after 5 years. It's going to be on interest only. So there's no amortization because you're just paying the interest. Here's a 7-year, here's a 10-year. And the max loan amount, underwritten NOI should be the same on all three. And you can see their debt service coverage ratio is right on the money. So what they're doing is they're basically determining their maximum loan amount based on their DSCR here. You got your annual interest only payments. This deal is, you can see it's like a 20. Yeah, that's why this deal sucked. We looked at it, we didn't like it, but the guy was asking $29 million for it. It was ridiculous. So see, they're only lending about 64% loan to cost here at $18 million. So there's your annual interest only payment, and then here's the amortized payment. That's what we just went through. Fannie Mae pricing tier 2, minimum DSCR is based off of the tier 2. And guys, I don't understand all the tiers. You can go Google that and look it up if you want. This is our index. It's 5-year U.S. Treasury and 7-year and 10-year. And then you've got your index rate plus your estimated all-in spread. And that gives you your actual interest rate. So these are not too bad. These rates have came down almost a full percentage from the peak, maybe even a little bit more than that. And then we've got initial prepayment term, type and term. It goes through the prepay, got the loan term, the amortization, the interest only, all non-recourse, all assumable loans, meaning someone, when they buy it, they can come in and requalify and take over the existing debt, which most multifamily is that way. Most residential is not that way. The only residential that's that way is VA loans. Monthly replacement reserves are going to be required, and tax and insurance reserves are going to be required. Lender fees, goes through all the fees, third-party reports, and their origination fees. Woo. Estimated total cost for this loan, about 200 grand. Total due at application, 20,000. Okay, guys, so that gives you an idea what that looks like and what you're going to be getting from these guys. Shows you kind of how to calculate it. Hopefully that gives you guys a pretty good understanding of what we're doing here. So let's do a summary. So we went through the benefits of debt. Debt is your friend. It helps you. It gives you leverage. It's got tons of tax advantages. We went through the types of debt in detail, went through all kinds of stuff there. And then the key things to remember when you're looking at your debt was to always start with your exit in mind, use accurate forecasts, make sure that you have cash flow, which the DCR will make sure of that. And then remember, everything comes from the net operating income. So that's the most important thing in multifamily is net operating income. We're always trying to do that value add. We went over the lending maxim. Remember, if you have a good deal, the debt's going to be easy to find. And we talked about the debt service coverage ratio. If it's below 1, that means you're negative cash flow. You don't want that unless you got deep pockets and some strange reason for buying a property that's going to cost you money every month. A negative or below 1 is a negative cash flow on debt service coverage ratio. Generally, you're going to need to be underwritten at 1.25 or higher. So you can tell based on a lot of things. Like this is kind of like the end of your napkin underwriting, right? You're going to actually figure out the debt coverage ratio so you know that it's above 1.25. If it is, you're good to go. All right, guys, so that's it. This was a longer video, and hopefully that gives you a great understanding of Debt 101. And go out and work some deals. Go out and do some examples. Go out and do your napkin underwriting. Do your debt coverage ratio. All the stuff that I've taught you so far in this course is going to make you dangerous, and you can actually go out and sound like you know what you're doing, and you can build your team, and you can start to get even closer to getting your first or next deal done. All right, good luck out there.